It is a rule of profound simplicity, and yet, in its application, it demands the highest levels of discipline. It is a rule that, if followed without deviation, acts as the ultimate shield against catastrophic loss and the ultimate test of a speculator's judgment. It is his number one rule for every single trade. The principle is this: a speculative commitment, if it is correctly timed, must show a profit almost immediately. If it does not, the position must be closed without hesitation, without hope, and without regret. This was not a mere guideline for Livermore, it was an absolute, non-negotiable law. He was not interested in buying a stock and waiting patiently for it to appreciate over months or years. That was the business of the investor. He was a speculator, and the business of the speculator is to profit from moves, correctly anticipated and correctly timed. An immediate profit was the market's own irrefutable confirmation that his timing was correct. An immediate loss was its equally clear verdict that he was wrong. The average trader, however, operates on a completely different and fatally flawed premise. He buys a stock, and if it declines, he holds on. He tells himself it is merely a temporary reaction, that his judgment is sound, and that patience will be rewarded. His capital begins to erode, but he is sustained by the treacherous emotion of hope. He may even be tempted to buy more, to average down his cost, believing he is acting shrewdly. He does not realize that he is violating the single most important rule of the game. He is reinforcing failure, and in doing so, he is paving his own road to ruin. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. Livermore's great rule was born from his understanding of the line of least resistance. He knew that a stock poised for a major move does not hesitate or equivocate. When the time is right, when the underlying forces of accumulation have completed their work, the stock will move, and it will move with purpose and direction. To enter a trade at the precise psychological moment, at the pivotal point where this move begins, is to align oneself with this powerful emerging force. The immediate profit is the tangible evidence of this alignment. It is the market's own way of saying, your judgment is correct. The path is clear. A loss, on the other hand, is a sign of resistance. It is the market telling you that your timing is premature, that there are still significant obstacles in the path of the advance. It may be that there is still a large amount of stock to be distributed by insiders, or that the market is not yet psychologically ready for the move. Whatever the reason, the message is the same. The line of least resistance is not yet in your favor. To remain in the position is to attempt to fight against this resistance, a battle that is both costly and unnecessary. Livermore stated it with the clarity of a man who had paid dearly for the knowledge. Experience has proved to me that the real money made in speculating has been in commitments in a stock or commodity showing a profit right from the start. This was not a casual observation, it was the conclusion of a lifetime of study. He had analyzed his greatest victories and his most devastating defeats, and the pattern was undeniable. His most successful campaigns were the ones that felt right from the very beginning. His most costly errors were almost always the ones where he held on to an initially unsuccessful trade, hoping to turn it around. This rule is, at its core, a ruthless mechanism for eliminating hope from the speculative equation. Hope, as he knew, is the amateur's greatest enemy, the siren's call that keeps him chained to a losing position. By demanding an immediate profit, Livermore gave himself no time for hope to take root. The trade was either right or it was wrong. The verdict was rendered not in days or weeks, but in hours, sometimes in minutes. This brutal, immediate feedback loop prevented him from ever becoming emotionally invested in a mistake. It also connects directly to his most foundational principle of risk management. The first loss is the best loss. By cutting a trade that is not immediately profitable, the speculator is, by definition, taking the smallest possible loss. He is eliminating the problem before it has a chance to grow into a capital-destroying disaster. He is paying a small, acceptable price for the invaluable information that his judgment was at that moment flawed. He preserves his capital, clears his mind, and stands ready to reevaluate the situation from a position of strength, not of desperation. The speculator who violates this rule pays a terrible price, not just in money, but in mental and strategic capital. A losing position held from the start becomes a constant source of anxiety and distraction. It consumes his thoughts, clouds his judgment, and prevents him from seeing other, more promising opportunities that the market is presenting. His capital is tied up in a failing venture, and his mind is imprisoned by the need to see that one trade vindicated. He is no longer scanning the entire market for opportunities. He is staring with desperate focus at a single festering mistake. This is how speculative ventures are allowed to decay into unwilling and often ruinous investments. A man makes a trade intending it as a short-term speculation. It goes against him. But instead of accepting the small loss as his original plan demanded, he decides to hold on, telling himself he has bought a good stock at a fair price and is now an investor. Livermore warned against this explicitly. One should never permit speculative ventures to run into investments. It is an act of self-deception, a way of avoiding the psychological pain of admitting a mistake. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not confined to a single individual. The history of speculation is rich with masters who, while sharing Livermore's core respect for risk, developed their own unique styles. From the mechanical box theory of Nicholas Darvas, to the volume spread analysis of Richard Wyckoff, to the turtle trading system of Richard Dennis, from the deep value principles of Peter Lynch, to the pioneering trend analysis of Charles Dow and the modern psychological insights of Ed Sikota, there is a pantheon of genius to study. To explore this rich history, we have launched a new channel dedicated to the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding, the link to this new channel is in the description below. Livermore's #1 rule is not a call for frantic, minute-to-minute trading. The time frame, whether it is 24 hours or 2 days, is less important than the principle. The principle is that the market's reaction to your entry must be favorable and swift. A stock that is truly ready to begin a great advance does not typically linger at the starting gate. It moves. A stock that stagnates, that churns back and forth without making progress, or that immediately yields to selling pressure, is a stock that is advertising its own weakness, or at least its lack of immediate readiness. To follow this rule is to demand that the market proves you right, and proves you right now. It is a shift from a passive, hopeful stance to an active, demanding one. The speculator is not a supplicant, begging the market for a profit. He is a professional, making a calculated commitment and expecting an immediate return on his investment of capital and judgment. If that return is not forthcoming, he withdraws his capital without a second thought and redeploys it elsewhere. He is a manager of probabilities, and a trade that is not immediately profitable is, by definition, a low probability venture. This rule, then, is the ultimate filter. It is the gatekeeper that stands at the entrance of every trade. It separates the high probability, correctly timed entries from the premature, hope-fueled gambles. It ensures that the speculator's capital is only ever committed to positions that are in harmony with the market's immediate current. It is the mechanism that enforces the discipline of timing, the foundation upon which all of Livermore's greatest campaigns were built. To adopt it is to take the first and most critical step away from the mindset of the amateur and toward the cold, calculated, and ultimately profitable world of the professional. To understand the profound power of Livermore's #1 rule, one must first understand what he was looking for in those first critical hours and days after entering a trade. The immediate profit was not merely a financial gain, it was a signal, a piece of vital information, a confirmation from the market itself that his timing was correct and his judgment was sound. But what did this confirmation actually look like on the tape? It was not just a single uptick. It was a collection of specific, observable behaviors that, taken together, told him that he was in harmony with the market's true line of least resistance. The first and most important signal of confirmation was the character of the move itself. A stock that is truly ready to begin a great advance does not do so timidly. It moves with force and conviction. When Livermore entered a trade at a pivotal point, he expected to see an immediate and decisive move away from that price level. A stock that churned back and forth, that hesitated and struggled to make progress, was a stock that was advertising its own lack of readiness. It was a sign that there was still significant resistance to be overcome, and to remain in such a position was to invite the unnecessary risk of a sudden reversal. This movement, he observed, should be accompanied by a distinct increase in volume. Volume is the engine of a price move. A breakout on low volume is often suspect, a sign of a lack of broad participation and conviction. But a breakout on a sudden, dramatic surge in activity is a powerful confirmation. It shows that other market participants, the floor traders, the public, and perhaps other informed interests, are seeing the same thing and are acting on it. It is the market's own way of endorsing the move, of providing the fuel necessary for a sustained advance. Another critical sign of confirmation was the ease of execution. When Livermore was correct in his timing, he found that accumulating his line was a relatively straightforward process. If he was buying, he might have to bid the price up slightly, but the stock would be available, and the market would readily absorb his purchases without faltering. This was a sign of a healthy, liquid market with broad underlying demand. The trade felt right because it flowed with the natural current of the market. Conversely, if a trade felt like a struggle from the very beginning, it was a profound danger signal. If, in trying to buy a stock, he found that his own purchases were the only thing holding the price up, that the moment he stopped buying, the price began to sag. This was a clear indication that he was on the wrong side. He was attempting to single-handedly fight a tide of selling pressure. This was not a position of strength, but one of extreme vulnerability. The trade was not acting right, and therefore it had to be abandoned. This same logic applied to the behavior of the stock relative to its group and the overall market. Livermore was a firm believer in following the leaders. He knew that the great market trends do not happen in isolation. They are led by the strongest stocks in the strongest industry groups. Therefore, a critical form of confirmation for any new trade was to see sympathetic movement from its sister stocks. If he bought a leading steel stock at a pivotal point, he wanted to see the other major steel stocks also begin to firm up and advance. This harmonious group action was a sign that a broad, sector-wide move was underway. It was a confirmation that his judgment was not based on an isolated anomaly, but on a powerful, underlying current that was lifting all ships in that group. It provided an immense sense of confidence and security. He was not just in a single, correct trade. He was participating in a great, validated market movement. The absence of this confirmation was an equally powerful warning. If he bought a stock and it advanced, but the other stocks in its group refused to follow or, worse, began to decline, he would grow immediately suspicious. It was a sign that the strength in his stock might be a manipulative move or an isolated, unsustainable flurry of buying. A leader without an army is not a leader. It is a target. He would often sell a position even if it was showing a small profit if its group failed to confirm the move. Ultimately, Livermore's #1 rule was a complete, multifaceted diagnostic tool. The profit he was looking for was not just a green number on his ledger. It was a composite picture of market health. It was a decisive price move, on convincing volume that was easy to execute, that did not look back, and that was confirmed by the sympathetic action of its peers. When all these factors aligned, it was the market's own unambiguous signal that a great and profitable opportunity was at hand. This is what gave him the confidence to sit tight, to pyramid his position, and to ride the great swings for all they were worth. His confidence was not born of ego or hope, but of the accumulated evidence of the market's own behavior. He had a reason, a powerful and validated reason, for his conviction. This is the great psychological benefit of his rule. It replaces the anxiety of uncertainty with the calm confidence of a confirmed diagnosis. For the modern trader, this principle is as true today as it was a century ago. Before you commit your capital, you must demand that the market proves you right. Do not be content with a trade that goes nowhere or immediately goes against you. Do not hold on to a position out of hope. Look for the signs of immediate confirmation. Is the move decisive? Is the volume convincing? Is the stocks group acting in harmony? If these confirmations are absent, you must have the discipline to accept that your timing is wrong. Cut the trade. Take the small loss. Preserve your capital and your mental clarity. There will always be another opportunity, another day, another trade. But that next opportunity is only available to the speculator who has had the wisdom to survive his own inevitable mistakes. This, then, is the ultimate meaning of Livermore's great rule. It is a commitment to trading only the highest probability setups. It is a discipline that forces the speculator to act only when the market's own powerful forces are aligned in his favor. It is a simple but profound method for ensuring that when you are right in a big way, and when you are wrong in a small and insignificant one. It is not just the #1 rule for every trade, it is the #1 rule for a long and profitable career.